Welcome to The Explainer. Today, we're going to break down one of the most important financial skills you can possibly learn, investing. We're going to build the foundation you need step by step so you can get started with confidence.
Let's kick things off with a simple but really important question. You work hard for your money, right? But is your money working just as hard for you? Because if it's just sitting in a bank account, I can tell you right now, it's definitely not.
Okay, first things first. Let's clear up something that trips a lot of people up. You hear the words saving and investing all the time, and they sound kind of similar. But trust me, they are completely different tools for totally different jobs.
So here's the breakdown. Saving. That's all about safety and your short-term goals, like building an emergency fund. It's super low risk, which is good, but you also get almost no return. Investing, on the other hand, well, that's the long game. You're taking on a bit more calculated risk for the potential of much higher returns. And that is how you build real wealth for big goals like retirement.
You know, the legendary investor Warren Buffett really put it perfectly. He said investing is all about putting money out now so you can get more money back in the future. It's not just about stashing it away, it's about putting it to work.
So, if that's the goal, what's the most powerful tool you have to get there? And here's a hint. It's not about being a genius who can pick the perfect stock. It's actually something we all have. Time.
The magic ingredient here is something called compound growth. It's so powerful, Einstein supposedly called it the eighth wonder of the world. The idea is pretty simple. The returns your investments make start earning their own returns. It creates this amazing financial snowball that starts off small but can grow into an absolute giant over time. To really see this in action, let's tell a little story about two investors. First up, meet Jill. We're going to call her the early investor. She gets started and puts some money away at age 25.
And then we have Jack, our late starter. Now, Jack is just as smart as Jill, but he waits just 1 decade later, starting at age 35.
Okay, now this is where it gets absolutely wild. Jill invests for only 10 years and then she stops completely. Jack, on the other hand, starts later, but he invests for 30 straight years. That's 3 times as long. So, who do you think ends up with more money?
Believe it or not, Jill comes out ahead by almost $10,000. I mean, think about that for a second. She invested for a third of the time, she put in $24,000 less of her own money, but she still ended up with more. Why? Because that first decade gave her money so much more time to compound that Jack could never ever catch up. That is the unbelievable power of starting early.
Time also helps you fight a silent enemy, one that's constantly eating away at your savings, and that's inflation. It's the reason a dollar today buys way less than it did 20 years ago.
I mean, look at this. The same stuff that cost you $100 back in the year 2000 would have cost you over $152 just 2 decades later. If your money was just sitting in cash that whole time, you effectively lost over a third of its value. Investing is your best weapon to help your money grow faster than inflation can shrink it.
And historically, investing has really been the answer. This chart shows what would have happened to a single dollar if you invested it in the S&P 500, which is basically just a mix of 500 big U.S. companies. Yeah, you can see those scary drops along the way, but the long-term trend is undeniable. It goes up. For investors who can just stay the course, it really pays off.
And that leads to a crucial piece of wisdom from the famous investor Benjamin Graham. He said that the biggest problem for an investor, their worst enemy, is usually themselves. It's not a market crash that does the most damage, it's our own emotional reaction to it, panicking and selling at the worst possible time. Your behavior is everything. So if the key is to control your own behavior, how do you actually do that? Well, you need a plan. You need to build a financial blueprint that can guide your decisions and keep you from going off the rails. And a fantastic tool for this is what's known as the SMART framework. It helps you go from a vague idea like, I want to retire someday, to something really solid and concrete, like I'm going to invest $200 every month for the next 30 years to hit my goal of $500,000. It turns a wish into an actual actionable project. As the saying goes, a goal without a plan is just a wish. It's so true. But you know, even with a great plan, you need the right mindset to actually follow through, especially when things get a little bumpy. And that's really the final piece of this puzzle.
This brings us to the core principle of all investing, this constant balancing act between risk and reward.
A really simple way to think about this is the risk-to-reward ratio. Before you make any investment, you just ask yourself, for every single dollar I could possibly lose here, how many dollars could I potentially gain? This one question helps you make calculated decisions instead of just gambling.
Think about it. Gambling is often a one-to-one bet. You're risking $1 for the chance to win $1. It's basically a coin flip. Smart investing is totally different. You're always looking for those opportunities where you might risk $1 for the potential to make 3, 4, or even more.
The goal is to always find opportunities where your potential reward is way bigger than your risk. Look, you're not going to win every single time. Nobody does. But by consistently putting the odds in your favor, your wins can more than make up for your losses over the long run, and that's how your wealth really grows.
So, let's do a lightning-fast recap. We learned the huge difference between saving for the short term and investing for the long term. We saw the mind-blowing power of time and compounding. We broke down exactly how to build a real plan using SMART goals. And finally, we talked about getting into that investor's mindset of always weighing risk and reward.
You now have the foundational blueprint. You have the building blocks. Your financial future is literally a story that's waiting to be written, and the next page is completely blank. The only question left is, how are you going to start your first chapter? Thanks for joining me.